I salute you all. Thanks for watching. Thanks for being on. And today, the topic that I want us to pass through, or the topic that I want us to look at, or in the course unit of the law of banking and the negotiable instruments. The negotiable instruments, those are the checks, among others. Then the law of banking. But today, before going to the negotiable, we are going to look at the law of banking. And basically, we are going to start with the definition and the relationship between a banker and a customer. So put that in mind. So when you look at the law of banking, it is a course unit that we can all pass. You get? And basically, probably these are the things that we practice outside there under the law of banking. Because hopefully most of us have accounts in banks. Even if it is not a bank, maybe any circle, anything. So basically, we are looking at it. And the definition that I can give about what a bank is, it is not clear, but I will start with the banker. Understand? We are looking at the definition and the relationship of a banker and a customer. And the good definition of a bank or a banker, basically, first of all, it was brought out when you follow the case of United Dominion Trust Limited versus Kinghood. Here, Lord Denning said that, you understand, that like many other beings, a banker is easier to recognize than to define. What does that statement mean? You can recognize it, but defining it is very hard. You get? Then we have some of the statutory authorities that defined the same. We have the Bill of Exchange Act, Cap 65. It defines a banker to include a person, a board of persons, whether incorporated or not, who carry on the business of what? Of banking. You get? Then we have the Evidence Bankers Books Act, Cap 7, which provides that a bank or a banker means any person carrying on the business of banking in Uganda. Then we have also the Financial Institutions Act of 2004. Bear in mind, we have the amendment of 2016 and the recent. But I'm using the Financial Institutions Act of 2004, which defines a bank to mean any company licensed to carry on a financial institution business as its principal business, as specified in the second schedule of the Act. And refer to the second schedule and you get the good explanation or the further explanation to the same. Then the good case that brought out, it was brought by Lord Denning in the case of United Dominion Trust Limited versus Kinghood of 1966. Actually, this case here, it is where this finance company bought an action to recover a loan made to the dealer. However, this dealer, for him, pleaded that the company was unregistered money lender, and that the contract was accordingly illegal. So bear in mind that here, realize that he said that the loan was illegal. So Lord Denning had this to say. You get? However, this bank was proved. It was proved that the finance company was regarded as a bank in the city, and that it enjoyed some privileges given to banks, as it had a clearing number. So the finance company also received the deposit checks from the public, among others. So when this case came to Lord Denning had this to say. He said that banks normally have two characteristics. One of them, they accept money from and collect checks from their customers and place credit to them, and place them to their credit. Second, he said that they honor checks. They honor checks or orders drawn on them by their customers when presented for payment, and debit their customers accordingly. He said that those are the two distinct characteristics of a bank. And this is where he said that a bank is easier to recognize than to define. So the dealer was liable to pay the loan. You understand? Because this finance company was regarded as as a bank. So put that in mind. Then when you look at who is the customer to the bank, who is the customer? So basically what you have to bear in mind here is that a customer is anyone that is having an account in the bank. You understand? If you don't have an account in the bank, you are not a customer of that bank. Whereby there is a case of Woods versus Martins Bank Limited of 1959. Here court said that an agreement to open up an account is sufficient to constitute the person a customer of the what? Of the bank. So if you open up an account in the bank, then there you are a customer to the bank. And also when you read the case of also, is it Great Western Rail versus London and Country Banking Company Limited of 1901, where the person, where I held that the person was not a customer of the bank who had no account in any suit with the bank. You understand? So put that in mind or put that on your know. You get? For a customer, who is a customer? Anyone that is having an account in the bank is the customer. You get? So put that in mind. So here, then we are going to the nature of relationship between a banker and a customer. What do we mean by the nature of the bank, the nature of the bank and the customer, the relationship? So actually the good that can describe what the relationship between a bank and the customer is a case law. Case law is good. And what you have to know that the relationship between a bank and a customer is contractual. You understand? A contract is a contract. And there must be also a fiduciary relationship of trust and confidence. You get? I'll also emphasize on a contractual relationship. We have all studied contract law. We all know we mean what a contract law. You get? You must abide by the terms and conditions. There are implied terms and express terms in a contract. So the duty or the relationship between a bank and a customer, they are what? They are contractual. This was evidenced in the case of Sudan Commercial Bank Limited versus Al-Sadiq Muhammad Al-Sadiq, whereby the Court of Appeal of Sudan held that the relationship was what? Was contractual. Then there is also the case of Esso Petroleum Company versus Uganda Commercial Bank Civil Appeal, number 14 of 1992. It also held that the relationship between a bank and a customer is contractual. You get? In case where there is a breach, the party to breach is what? Is liable to the other. So put that in mind. And also in addition, there is a case of Immobile Uganda Limited versus Uganda Commercial Bank. They are held that the contractual relationship between a bank and a customer, it can either be implied or expressed. You get? And the most fundamental term in that the banker must undertake to borrow money from the customer, as when the customer lends to him and to deposit in his account until the customer demands to it. What are they trying to mean is that if a customer puts money on his account, is borrowing the bank, and that money becomes the property of the bank until the customer demands for it, and it must be given to him on demand. You get? That's what I'm trying to bring. And the good case of Joachimson versus Swiss Bank Corporation, the case of Joachimson versus Swiss Bank Corporation of 1921, that is a good case that brings out the ingredients, that brings out the elements. You get? Actually, it was Lord Atkinson who said that where the partnership that maintain an account with the dependent bank or the defendant bank, one of the partners brought an action claiming in the partnership named the repayment of the amount. That was the case. The one was claiming the name of repayment of his amount that he had deposited in the bank. The customer on his part, these are words of Lord Atkinson. He says that the customer on his part undertakes to exercise a reasonable care in executing his written orders so as not to facilitate forgery. Written orders most on the checks. When you're a customer, when you're writing on a check, you must take reasonable duty of care. We shall see duties of a bank and a customer. You have to take reasonable care in executing written orders to the what? To the bank, so as not to bring what? Forgery. You understand? That is an implied term to the customer. And also, Lord Axon also said that the bank is not reliable to pay to the customer until the customer demands what? Payment. You understand? It's not liable to pay to the customer his amount until he demands for what? Payment. You have gone to withdraw your money. You understand? Remember, when you deposit bank, you have borrowed in the bank, but it will pay you until you demand for it. Lord Atkinson laid down 3 principles. One of it was that demand exists in the case of current or savings account which are provided for payment at what? At call. Secondly, the amount standing on the customer's credit becomes payable without demand when the bank is being what? Winding up. It's being wound up, or if the bank-customer relationship is what? Terminated, or is being what? Terminated. You get? Then there is also where a contract exists between the bank and the customer based on maintenance of the what? Of the account. So putting that in mind, that's what Lord Acton speculated 3. So put that in mind. And when you go further, there's also a good case of Chilala versus Republic of 1973. It was the Court of Appeal of Malawi. Under this case, they said that when a person pays his or her money into his or her bank account, that money becomes the property of the bank. You get? And the relationship between the bank and the customer becomes that of a creditor and a debtor. You understand? Creditor and a debtor, with the addition that the bank promises to honor the customer's checks on what? On demand. You understand? For him, he said that the relationship is between a what? A creditor and a what? And a debtor. So put that in mind, or bear that in what? In mind. Basically that's it. So that's the brief that I can talk about a bank and it's really what a bank, customer, and a bank customer. So basically note that in mind, and the relationship. So we shall also look at the duties in another what? Snap. So thank you for watching and thanks for listening. Anything that you feel that you are not well versed with it, please put it in the comment section. We shall reply to the same. Thank you all. Thanks for listening. And I wish you the best. Thank you.